Hello and welcome to another video on how to secure yourself financially. So what I'm going to do here is to jump straight forward to the last, or at least one of the first financial statement. So over the course of these several videos, I learned about what financial statements do, what are the different type of financial statements, balance sheets, income statement, and cash flow. Focus to know more about them and to get a practical aspect, to get my hands dirty on that. And also by looking at places like Yahoo Finance, from companies like Coca-Cola, IBM, or Apple, where you can see their balance sheets, income statement, and cash flow. So here in today's video, I'm focusing on the cash flow, okay, and how this is made of. After all, this report is the company inflow and outflow of cash. So it reviews the information from the balance sheet and the income statement, and the bottom line of these statements show the net increase or decrease in cash. And this is important because companies need to have cash on hand, much like persons, to pay this expense, rent, utility, as well as taxes, among other things, and purchase assets. So this is generally made of three parts. This cash flow statement will review the cash flow from these activities: operating, investing, and financing. So operating activities, what it does here is it analyzes the net income from the income statement and conciliate with the total amount of cash that was used or perceived from operating activities. So most common operating activities can be laid down into operating assets and operating liabilities, where in the operating asset we have things like accounts receivables, inventory, prepaid expense, which is expense that a company incur from goods and service that will be received based on money that, so based on payment that has been done for goods and service that will be received, such as rent, prepaid or premium insurance, health for medical coverage, long-term care like nurse and home health care, liabilities like for lawsuit, for example, disability that prevent you from working, life in the event of the policyholder's death, or home, vehicles, rent is another prepaid expense, marketing, software license, office supplies, as well as maintenance contract that belongs to prepaid expense. Another most common operating assets is intangible assets like patents, trademark, copyrights, trade secrets, goodwill, customer relationship. Joint venture is another common operating expense, such as, or in this case, is investment in affiliates like joint ventures. So, for example, Crocs and Post Malone, they make that. Equity investments like Warren Buffett, Berkshire Hathaway, led by Warren Buffett, that invest in a variety of sectors like industry, energy, or real retail. SoftBank, a Japanese conglomerate that invests primarily in technology companies such as WeWork, Uber, Alphabet, the Google parent company, or the parent's Google company that invests primarily in technology companies. For example, Calico, which is focused on longevity. TPG, Texas Pacific Group, which is a private equity here that invests primarily in real estate, healthcare sectors. Limited Partnership, which is another investment in affiliate. Associates, and cash equivalent, another most common operating assets. For example, like money market funds, when a company can look to these funds to get fast liquidity, where these funds focuses on the purchase or sales of very short-term debt financial instruments like bank acceptance, very short-term debt issued by banks, certificate of deposit, saving certification with short-term maturity issued by banks, commercial papers, unsecured corporate debt, and repo, this repurchase agreement, which is very short-term debt issued by the government. And when I look at the most common operating liabilities, we have accounts payables, accrue expense, so money that a company incur from good and service that has been received but not yet paid for. For example, rent, taxes, utility bills, salaries, deferred revenue, so obligations that a company has to provide for good and service from money that has been collected. So we have here like prepaid subscription service like Netflix or Spotify, or the gift cards. Income tax payable, so money that a company owns to the government, whether it's corporate taxes or withholding taxes, as well as sale taxes, whether it's the county, state, VAT, or excise, and GST. And then also look at short-term borrowings, especially for companies that they want to meet their financial needs, such as bank loans, line of credit, commercial paper, so they can issue debt, also trade credit, so they renegotiate with their suppliers and vendors. Company renegotiate with their suppliers and vendors their repayment schedule. Outstanding invoice, a way to raise funds from a lender based on an outstanding invoice. Payroll advance, money that the company or your employee provide to employees that will be deducted in the next payday. And notes payables, which is a promissory note, meaning it's a pagaré in Spanish, between the borrower and the lender, when the borrower create an agreement outline all the terms and conditions to the lender. So here we have banks. Anytime you ask a loan for a bank, the bank loans, it generates a notes payable indicating the principal, the interest, as well as the repayment schedule. From business, so company can go to financial institutions such as venture capital or private equity to raise funds, for example, to borrow money. Bonds, whether it's from corporations or governments, right? So it generates this notes payable that outlying is the principal as well as the interest and other terms and conditions. Trades payable, but this is in some case companies may renegotiate it is repayment schedule with the suppliers and vendors, and it automatically generates these notes payable. Also, notes payables to individuals or business, where now it aligns all the terms and conditions from the borrowing for the borrower to the lender, whether it's an individual or a company. And also, we have the how do you put it? Installments loans. Okay, this is when you, for example, ask for a lender to purchase assets. You automatically generate this notes payable. Again, this is example of this notes payable, which is very, very important, especially to understand one of the most common operating liabilities and warranty obligations. Okay, so warranty obligations are obligations that a company has to provide to fix or replace a defective product that doesn't or so these warranty obligations are a way for a company to replace or fix a defective product or a product that doesn't meet certain quality standards. So you have manufacturing warranties, software, parts, vehicles, home, service. So this is just to describing is all of these most common operating assets and liabilities that the cash flow, the first part of the cash flow statement analyze. Okay, so it will analyze the net income from the income statement, so how much money a company made, and adjust that with the total amount of cash that was used or received from any of these activities that I mentioned, from any of the operating activities. Okay, that actually is a very boring task, might be, okay, but someone has to do. For example, here we have operating gain losses, depreciation and amortization, deferred taxes, stock-based compensation, which is another. So the way of how it does this is first by look at the net income and adjust for any non-cash items that affect the company. Items that affect the income statement where there is no cash transaction involved. For example, depreciation and amortization is one of them. Stock-based compensation will also affect is the net income, all right? And, well, it adjusts the total amount of cash that was used or perceived from any other operating activities as well. So on the investing cash flow statement, which is the second part, generally this involves the purchase or sale of long-term assets like intangible assets, property, plant, or an equipment, investment, installment, or in this case, leasehold installment, or leasehold improvement, exactly, which is another long-term asset. Leasehold improvement, and yeah, so leasehold improvement, goodwill. Okay, this is example of long-term assets. So, for example, if a company decide to purchase goodwill, so brand recognition, so brand reputation, so it wants to purchase the goodwill of another company, so that activity is registered as a cash outflow because cash was used in that operation. However, if a company decides to sell some of its investment or decide to sell some of their leasehold improvement, that activity is registered as a cash inflow because cash was perceived from the operation. So that's actually pretty straightforward with the investing activities. And when it comes to financing activities, that it involves the company long-term liabilities, long-term responsibilities, obligations, and equity ownership, right? So Investopedia mentioned that this is so this focus, so the focus of the financing activity in the cash flow statements focus on how a firm raised capital and pays back to the creditors through capital markets. So if a company is consistently, so if a company consistently, for example, so if the company cash flow comes most of that from its operating activities, that's a good sign of a good investment. You know, if the cash flow investment, which is that, according to Investopedia, so if the company's cash flow comes primarily from operating activities, that's a good sign of a good investment. However, if a company is constantly raising funds through issuing stocks, or it's constantly doing that, it's constantly raising funds. Yeah, it's constantly raising funds by issuing stocks or taking out of debt. That might be not a good. That might be a good. That might be not good. That might be not a good sign of an investment, because most of it is financing activities or the cash flow activity, comes is from borrowing money from the others. It's from the outside world. It's not from its operation. That makes sense. That makes a lot of sense. That makes a lot of sense. So you can think of that as if you have a parent that are constantly giving you money. So it's like you don't know how to do your thing, you know. You don't know how to handle your own finance. And the financial cash flow indicate is where the company this indicates where the company is raising its funds, how often a company is raising its funds, how often. So this financial cash flow helps investors to see how often and where this company source where so how often and where is the source of capital for these companies, right? So for example, here you have things like cash dividend paid, next common stock issuance, meaning is that if a company relies solely on issuing stocks, that's not a good sign of investment. That might be not a good sign of investment. And common stock payments. Similar to this net long-term debt issue, long-term debt issuance, long-term debt payment, and common stock issue, common stock dividend payment. You know, this activity is registered as a cash inflow because all of this because all of this indicate is, well, that they're raising funds by issuing stocks and common stock payments and common stock dividend paid and cash position. So so that'll be all for this operating activities and investing activities as well as financing activities. Okay, so again, these financing activities involve the company's long-term liabilities and equity. So this part of the financial statement focus on how a firm raised funds and paid back to the creditors or investors through capital market. So this helps to investor to see this part is financial activity from the cash flow statement, helps investors to see how often and where this company capital source come from. Because if a company cash flow primarily comes from its operating activities, that's a good sign of investment. However, if constantly relying on issuing stocks or taking out of debt, that might be not a good sign of investment. That might be not a good sign. Okay, cool. So keep reading now of the footnotes. A horse called Read the Footnotes ran in 2014 Kentucky Derby. He finished 7th, but if he had won, it will have been a victory for financial literacy proponents everywhere. It is so important to read the footnotes. The footnotes to financial statements are packed with information, and here are some of the highlights. Significant accounting policies and practice. So companies are required to disclose the accounting policies that are most important to the portrayal of the company's financial conditions and results. What does it mean with the accounting policies? What are accounting policies? With example, the specific principles and procedures implemented by a company management team that are used to prepare its financial statement. So accounting policy are specific procedures implemented by a company management team that are used to prepare its financial statement. This includes any accounting methods, measurement systems, and procedures for presenting disclosures. Accounting policies differ from accounting principle in that the principle are accounting rules. Wait, what? Accounting policies differs from accounting principles in that the principles are the accounting rules and the policies are the company's way of adhering to those rules. So the accounting policy are the policies that a company the policies the company policies the policies a company's way to adhere to those rules and the accounting principles. Accounting principles, how they work, GAAP and IFRS. Accounting principle. This rule of guidelines that company and others bodies must follow when reporting financial data. Rules and guidelines. International Financial Reporting Standards is the most widely used set of accounting principles with adoption in 176 jurisdictions. The United States uses a separate set of accounting principles known as General Accepted Accounting Principles. Jesus. Generally accepted accounting principles. Holy hell. What are international financial reporting standards? A set of accounting rules for the financial statement of public company that are intended to make them consistent, transparent, and easily compared around the world. But this is from company or public companies. In GAAP, understanding it and the 10 key principles. U.S. public company must follow GAAP for their financial statement. GAAP, General Accepted Accounting Principles, and Financial Reporting Standards. Interesting. So it all begins here by looking at read the footnote. So significant accounting policy and practice. Okay. So companies are required to disclose the accounting policies, like how they adhere to the accounting principles, whether it is GAAP, generally accepted accounting principle, which is a set of rules, a set of standard and rules governing the accounting professional. U.S. public companies must follow GAAP for their financial statement.
Generally accepted accounting principles, or GAAP, are a set of official rules, standards, and procedures that publicly traded companies are required to use in preparing their financial statements. GAAP standards dictate how companies record and report their financial data and are used to ensure consistency and accuracy in accounting practices. The Financial Accounting Standards Board, FASB, is the source of most GAAP rules in the United States. GAAP principles are supposed to give investors confidence in the accuracy of a company's financial statements and help investors accurately compare one company's financial statements to another's, especially when those companies are in the same industry. Some examples of GAAP being used include how quarterly financial statements are prepared in the same manner as annual financial, and how current assets should include cash, marketable securities, accounts and notes receivable, unearned income, inventory, and prepaid expenses. However, despite GAAP's good intentions, companies often have discretion to use varying methods for valuing assets and recognizing costs and revenue. This means that there is still room for companies to fudge the numbers, so investors need to examine financial statements carefully for signs of manipulated accounting data. Investors should read the company's summary of significant accounting policies and all of the footnotes to its financial statements, which contain key information to supplement the figures on the company.
This footnote contains key information to supplement the figures on the company financial
statements.
Because read the footnotes. Mm-hmm. 10 principles of GAAP: regularity, consistency, sincerity, permanence of methods, principle of non-compensation, prudence, continuity, periodicity, materiality, utmost good faith, not GAAP compliant. Interesting. Not GAAP compliant. Somewhat compliant. Somewhat compliant. Mostly GAAP compliant. Fully GAAP compliant. And they don't adhere to that. In the US, they don't even adhere to that. Okay.
International Financial Reporting Standards, IFRS, are accounting rules and guidelines governing the reporting of different types of accounting transactions and events in financial statements. Accounting standards such as IFRS are important because they provide the backbone for integrity and trust in the financial markets. When all corporations are required to adhere to one set of accounting standards, investors can be confident that the financial information they use is accurate and can be compared between all companies and across all market sectors. Most countries follow IFRS, except for the United States, which follows generally accepted accounting principles issued by the US-based Financial Accounting Standards Board. Canada also has its own rules of generally accepted accounting standards. The International Accounting Standards Board sets IFRS. Their goal is to create one set of accounting standards throughout the world. This goal is especially important due to ever-increasing globalization and the growing number of multinational corporations.
And the ever-growing multinational corporations, man. So to promote that transparency and things like that. This is the balance sheet. Profits and loss statement, or the income statement, comprehensible income, statement of change in equity and cash flow. The US and China each have their own system. You gotta be fucking kidding me. You gotta be. Who use around the world the International Financial Reporting So international financial reporting standards. But this is our accounting principles or accounting rules for the financial statement of public company that intends to make them consistent, transparently, and easy. To make them consistent, transparent, and easily comparing around the world. Since the emerging of multinational companies around the world, to make it much more easy to do that. Holy hell. For domestic public company, IFRS standards are permitted but not required for domestic public company. Interesting. Required, permitted. So China, according to this, China's national standards are substantially converged with IFRS standards, and China has committed to adopt IFRS standards for reporting by at least some domestic companies, although there is no timetable for completion of the process. Chinese companies represent more than 30% of the total market capitalization of the domestic market, produce IFRS compliant financial statements as a result of their dual listing in Hong Kong and other international markets. Okay, foreign companies do not trade currently in China's security market. Therefore, there is no relevant regulations on whether those companies will be permitted to use IFRS standards. So they are committed, but they don't adhere to that. Holy hell. Okay. Okay. Oh fuck. Okay. Okay. That's very, very, very interesting. So the significant accounts policy. This is the footnotes. Okay. So footnotes to financial statement. Footnotes in Spanish. This is el pie de página. Exacto, nota al pie. So footnotes contains so footnotes are or the footnotes to financial statements are packed with information. Here are some of the highlights. Significant accounting policy and practice. Because companies are required to disclose So companies are required to disclose the accounting policy that are the most important to the portrayal of the company's financial conditions and results. These often require management's most difficult, subjective, and complex judgment. But in any case, here are the things that are packed the footnote of the financial statement. Significant accounting policy and practice. So, how the company adhere to the accounting principles, whether it's GAAP, this generally accepted accounting principle, that the U.S. public companies follow in their financial statements, or the international financial reporting standards. The whole idea of this, according to Wikipedia, is due to globalization and the ever increasing on multinational corporations, they create this in order to make this report consistent, transparent, and easily compared with others around the world. Consistent, transparent, and easily compared around the world. Okay. Very, very interesting. So with that, that'll be all for this video. Take care. Bye bye.